Most people track global conflict the wrong way. They watch aircraft carriers in the Taiwan Strait. They count fighter jets. They follow military drills and satellite images like they're reading the future. But military hardware is performance. It's designed to be seen. A carrier group can be deployed for training, used for intimidation, or pulled back quietly in a week. Troops can be rotated. Exercises can be theater. If you want to understand whether a superpower is preparing for a long, irreversible confrontation, don't look at the battlefield. Look at the balance sheet. Because war doesn't begin with missiles. It begins with something far less dramatic. The silent repositioning of capital, the slow detachment from dependence, and the deliberate dismantling of financial exposure. And right now, one number is flashing like a warning beacon. China's holdings of U.S. Treasuries have fallen to $688 billion as of October 2025. That figure doesn't just matter economically, it matters strategically. Sovereign debt isn't like stocks or crypto. It's not fast. It's not liquid in the way modern traders imagine liquidity. Dumping hundreds of billions in government bonds takes careful timing and months of execution, because selling too aggressively can destabilize markets and crash the value of what you still hold. That's what makes the message so powerful. When a nation like China begins reducing its exposure to US debt rapidly, especially in a bad market, it isn't acting like an investor. It's acting like a government preparing for the possibility of a hostile financial environment. Debt isn't just an asset. In geopolitics, it's a dependency chain. And dependency is the first thing nations try to eliminate when they expect conflict. To understand why $688 billion is such a big deal, you need the historical baseline. In 2013, China held roughly $1.32 trillion in US Treasuries, the peak of what analysts once called Comerica, a symbiotic financial engine where China exported goods, America imported them, China recycled dollars into US debt, and US borrowing stayed cheap. It was a closed-loop system that powered globalization. China got growth. America got cheap products and low interest rates. That system created stability, but also interdependence. Now it's unraveling. From the peak, China has liquidated nearly half of its treasury exposure, a reduction of over $600+ billion. This isn't minor portfolio management. This is a structural unwind. And the timeline matters. China didn't sell during the best years. It has been selling during a period when US bonds were depressed, yields volatile, and the bond market was experiencing a major drawdown. That's what turns this into a signal, because selling during weakness means accepting losses, and investors don't accept losses unless something bigger is at stake. Here's the hard truth. Selling treasuries in a weak bond market means you're selling at a discount. In normal finance, this is irrational. A large reserve holder typically sells slowly and strategically to protect value. So why is China doing it anyway? The standard excuse would be liquidity, that China needs cash, but that explanation collapses under scrutiny. China may have domestic challenges, property stress, slow growth, but it still runs massive trade flows and maintains extensive financial capacity. So if it's not desperation, then it's risk perception. Meaning, China has decided that US treasuries are no longer safe reserves. They are now strategic liabilities. This entire shift makes more sense through one moment. February 2022. Russia invades Ukraine. The West responds not primarily with troops, but with financial weapons. And the financial weapon that shocked the world was this. Roughly $300 billion of Russian central bank reserves were immobilized, frozen. Not private oligarch money, central bank money, state reserves. This was the moment every rival power learned something terrifying. Your reserves are only yours until the gatekeeper says otherwise. China watched that event and drew a conclusion that doesn't require speculation. If a Taiwan crisis escalates, treasuries are not a safe asset. They are a hostage. Even $688 billion held today could become unusable or frozen tomorrow under sanctions. So China is doing something that looks irrational in financial terms, but makes perfect sense in security terms. They'd rather take a 10-20% hit today than risk a 100% loss later. That is not market behavior. That is contingency planning. Now let's talk about the most suspicious part of this story. If China dumps hundreds of billions of treasuries, basic economics says supply rises, demand must match it. If demand doesn't match, bond prices fall. If bond prices fall, yields spike. And if yields spike, mortgage rates explode, banks collapse under bond losses, federal interest payments surge, deficits spiral, the entire risk-free asset story collapses. So why hasn't it happened? Why aren't we seeing a full yield shock? Because someone is absorbing the supply. The buyer of last resort hasn't been the free market, it's been the alliance. The most revealing part isn't China's line item, it's who rises while China falls. Two names stand out in a way that feels abnormal. First one is the United Kingdom UK Treasury holdings surged to record highs, surpassing $750 billion. That puts Britain close to China's position. Despite an economy far smaller than China, a trade deficit, not surplus, heavy domestic debt pressure. So where's the UK getting the capacity to buy this much US debt? It's unlikely to be profits. It looks more like financial engineering through London, acting as a stabilizer, a shock absorber, or even a conduit for other flows. And the last one is Belgium. Belgium's holdings appear in the $370 billion zone. And this is where sophisticated observers pay attention. Because Belgium, in sovereign finance data, often represents custodial pathways, especially linked to Euroclear type settlement plumbing. In other words, Belgium can function as a proxy, can represent hidden buyers who want anonymity. If these spikes align with China's selling timeline, the simplest explanation is not market opportunity. It's strategic necessity. The United States bond market cannot break, because if the US bond market breaks, global collateral breaks. Treasuries are the base layer of banking stability, interbank lending, reserve management, derivatives, collateral, pension asset allocations, liquidity systems. So the Allies may be absorbing supply not because it's profitable, because the alternative is catastrophic. This creates a dangerous system. China sells, the Allies buy. The US stays stable. But here's the flaw. Capacity. China bought treasuries because it earned endless dollars from exporting real goods. The UK and Europe don't have that same structural surplus engine. If they absorb too much supply, they weaken themselves. This turns US debt from a global reserve asset into something narrower. A bloc reserve asset. A NATO reserve asset. Not the world's. Here's the real pivot in this story. When China sells treasuries, it receives dollars. But China increasingly sees dollars as inflation-prone, traceable, sanction-vulnerable. So they don't want to hold dollars either. Which raises the question, where is the money going? The answer appears to be hard assets, not as an investment trend, but as a national survival strategy. So let's delve into the 4 stockpiles that explain the entire exit. Number 1 is gold, the anti-dollar reserve. Gold has no counterparty risk. No one can freeze it digitally. No one can cancel it with a keystroke. This is why gold behaves like geopolitical insurance. China's buying pattern suggests a deliberate shift from credit-based reserves to collateral-based reserves. Number 2 is energy, building blockade. Resistance. China imports a large share of its oil. In a conflict scenario, the Strait of Malacca becomes a choke point, so building strategic petroleum reserves isn't optional, it's existential. Stockpiling oil is essentially stockpiling time. Number 3 is copper and strategic metals. War economy. Inputs. Copper isn't just for housing, it's for grids, vehicles, drones, munitions, and industrial expansion. If domestic property demand is weak, yet copper imports remain high, that signals industrial strategy, not consumer demand. And strategic minerals matter even more. Rare earths, lithium, cobalt, the raw materials of modern warfare and electrification. And number 4 is grain, food sovereignty. In global conflict, food becomes a weapon. Stockpiles are safety. A country preparing for disruption does not maximize yield. It maximizes resilience. This is the mindset shift. Peacetime wealth requires efficient paper instruments. Wartime wealth, just inefficient physical stockpiles. Physical stockpiles carry storage costs and earn no interest. But they produce something far more valuable: survival. Western analysts often mock strategic commodity hoarding. They sold treasuries at a loss. But that's a misunderstanding of the objective. China isn't optimizing for quarterly performance. It's optimizing for sanction resistance, supply chain continuity blockade, endurance national security. If a bond loses value but oil ensures industrial function, that trade can be rational, especially if you believe conflict probabilities are rising. The most dangerous conclusion isn't about China, it's about the transformation of treasuries themselves. For decades, US treasuries were treated as the world's neutral, risk-free benchmark, but now they resemble something else: a political instrument, a contested asset, a battlefield. If demand becomes dominated by political motivations instead of economic motivations, volatility becomes structural, because political buyers don't behave like investors. They buy until their currency breaks, or their voters revolt, or their own crisis forces liquidation. Let's see the positioning framework, a simple, policy-safe investor protocol. Rule number 1, reduce duration. Risk. Long-term bonds are extremely sensitive to yield changes. If yields rise, long bonds crash. So avoid being trapped in assets that can drop 15-30% simply from rate repricing. Short-term bills behave like cash equivalents. Rule number 2, add real asset exposure. If the endgame of bond market stress is central bank intervention and monetization, inflation risk rises. Real assets historically protect purchasing power better than long-duration paper. Rule number 3, watch the allies. As the early warning signal monitor, stress points like British pound stability, Japanese yen volatility, sovereign yield spikes in allies. If allies must stabilize themselves, they may be forced to sell treasuries, and that's when the market dynamic changes fast. The $688 billion number is not just finance trivia, it's a geopolitical timer. It suggests China is systematically reducing exposure to US jurisdiction and replacing it with physical resilience. Markets look calm, but the calm may be artificial, supported by allied absorption and political alignment. If that absorption capacity cracks, the adjustment may not be gradual, it may be violent. Because bond markets don't break slowly, they break suddenly, when confidence disappears. And confidence is exactly what China seems to be withdrawing.